Welcome to the real estate edition of That Business Show 2.0 with your host, Jamie Maloney. Each Thursday at thatbusinessnetwork.com, we air new episodes of the real estate edition of That Business Show 2.0, where on Thursdays, real estate becomes a show business. I myself's business is primarily real estate, working at Coldwell Banker and selling properties in excess of 1,600 now, with a specialty in the sale of bank-owned, aka foreclosed properties. And again, as always, learn more about myself at thatbusinessnetwork.com and also on jamiemaloney.com. We've also begun to rebuild the site at thatbusinessnetwork.com. A lot of new components are being added each and every week, and we've just got the real estate portal loaded into the new website. So once again, you can search for properties, request the free home valuation on that site directly, or just go still to thathomevaluation.com, and that will take you over to the site also. So a lot of stuff and a lot of great features coming on thatbusinessnetwork.com, and a lot of announcements and interactivity coming with the past guests as I build the site. No small task what I have planned for the site. So I continue to work on it each and every day, knocking out larger portions of it each and every week. So again, thatbusinessnetwork.com, where you can see each weekday morning new episodes of That Business Show, and on Thursday when we talk strictly real estate. So on today's program, I want to talk about the lending process, mortgages. In the second part of today's show, we're going to be hearing from Frank Coto, president of the Lincoln Lending Group, a great lending partner, help you out with any type of mortgage, from FHA and conventional to one day out of bankruptcy and one day out of foreclosure programs. He'll be talking about that later on today's program. And he even has products available for borrowers that have credit scores down to 500. There's a lender out there utilizing the FHA program with a score down to 500. So he'll be talking about that today and some of the myths of the FHA mortgage. And some of you are probably saying, well, FHA loans don't go down to that credit score. But in fact, there is no minimum credit score with FHA loans. And Frank will explain that on the second part of today's program, because FHA mortgages are insured by the federal government, and the lender makes the loan at their own discretion. Given that they have insurance on the loan, it's up to them to set the credit score required. Typically 580, 620, those are usually kind of household minimum credit scores that you'll see advertised a lot of times for less than high quality borrowers. But hey, if you're in a distressed situation, you've had some issues with bankruptcy or foreclosure in the past, or you don't have the best of credit and you like to buy a home, Frank Coto, who will be our guest on the second part of today's program, you want to stick around to hear that. And in the meantime, lincolnlend.com is his website. So I want to talk today about the importance of getting approved for a mortgage, also some of the questions you should be asking in the process when you're dealing with a loan officer. First and foremost, I want to stress the importance of getting a loan approval prior to calling a real estate agent or prior to making an offer onto a property. It's it's the number one tip I can give to anybody buying a home who's not buying with cash, is that you've got to be ready to know how to pay for the property. And it's not just enough to get a pre-qualification letter. In the industry, you'll hear pre-qualification and you'll hear pre-approval used interchangeably. Specifically, though, a pre-qualification letter is a preliminary report of the borrower's creditworthiness. When you call a loan officer and you get a pre-qualification letter, and mostly what they're going to do is they're going to run your credit, they're going to ask you for your income and expenses, and they're going to punch that into a program, and then based on what you tell them and based on the credit report that they get back, they'll issue you a pre-qualification letter. They are good guides for getting into the real estate market, and they give you a good idea of your ability to purchase and what you can purchase up to. But the benefit of having a pre-approval letter, and the difference is that you, the borrower, have run through the underwriting process. So not only have they asked you, but you've proven what you make, and they have issued you a conditional approval letter, subject at that time to the collateral on the property, which would be the house, and given that it has clear title and an acceptable appraisal, meeting at least the loan to value requirements of the mortgage. But the pre-approval process will take 1, 2, 3 weeks, depending on your lender and how quickly they are processing their documents. But pre-approval involves submission of your W-2s, your tax returns, a full analysis of your income and your expenses. A lot of times when people are doing the pre-qualification process, they neglect things like child support or alimony, or they forgot about a student loan payment that's on auto debit in their checking account. Things like that will creep up. And so it's very important to get a full loan approval. Ask your loan officer for a full loan approval, not just a pre-qualification letter. Some loan officers will tell you that, well, we don't issue full loan approvals until you have a contract on a home, and at that point you should probably go and seek somebody else. There are loan officers and banks out there that will give you the full loan approval prior to going onto the market. Now, from a selling agent perspective, this is very important because it enables you to position your buyer's offer in line with the cash offers, but you got to know how to present it and you got to know how to push it. A lot of people are trained to think that a pre-qual and a pre-approval are all the same. People a lot of times may not even be looking at them. The listing agents and the sellers may not be looking at them and what they actually mean. Be sure that the loan approval letter states on there that the documents have been received and have been reviewed and the borrower has been underwritten. The pre-qualification letters will say subject to verification of assets, subject to verification of W-2s. That means they haven't seen it. It means you've told them about it, but yet they haven't seen it. Two critical differences. And so when your selling agent presents an offer on a property, they need to drive home the point that, listen, my borrower is fully loan approved. Don't get concerned that they're getting a mortgage on the property. As long as you can guarantee it's clear title on the property and the home appraises for X, this offer is just as good as cash. So why would you be considering a lower cash offer because you're fearful that the borrower's mortgage financing isn't going to go through? You would have that fear if the borrower is just pre-qualified. But if they are pre-approved, then the risk of the transaction not closing is really on the seller side of the situation because they are the ones providing the collateral for the loan. Their house, they're saying that the home is worth at least what you're offering on the home, or at least they hope it is, and also that they have clear title to the property. Those are the only two things that can then derail a transaction once the borrower is fully approved for a mortgage. Remember, when you apply for a mortgage, there are two things that need to qualify: the borrower and then the asset or the collateral, which is what the loan is being secured against. People can complete the first part of that prior to ever going onto the real estate market and making their offers just as good as cash. Selling agents, very important that you demand this from your buyers, because if you're not, you're giving them poor representation. You're setting them up to be defeated on offer after offer because of the prevalence of cash that is in the marketplace right now. Tampa Bay, which is the market that I sell in, 40 to 50% of the transactions are closing with cash. So why would you want to put your borrower in an inferior position by accepting that they go to an offering situation with just a pre-qualification letter? So it's important to establish strong lending relationships with loan officers to get them in the game the moment that the buyers call you. Because as I said, the buyers should be calling the loan officers first, but 9 times out of 10, they call the realtor first. The realtor goes and shows them the property, gets the contract, and then they call the loan officer. That's not how real estate needs to be practiced. The buyer needs to call the loan officer, get fully loan approved for the process, then call the realtor. If they call the realtor first, the realtor should have a lender on demand at 24/7, or maybe not 24/7, but weekdays, during business hours, to take pre-approval applications. And again, the process will take anywhere between 1 and 3 weeks to issue you a pre-approval process. It's good real estate practice because it protects both the borrowers and the real estate agent's times and the seller's time from borrowers that are not qualified to purchase the property. And again, I've talked about this on other programs, and that's my belief why real estate commissions are high is because people are supplementing realtors to show properties to borrowers who aren't going to buy, who aren't going to qualify, and who end up with a zero commission at the end of the day, thus wasting their time. But they make it back up with the higher commissions that are offered on the listing of the properties and when they sell the properties, or if they're listing a property. If people would practice much better real estate practices, we would have lower real estate commissions. That's just one of my theories. I may be right, I may be wrong, but regardless, get fully loan approved before buying a home. Now, where do you go to get a mortgage on a property? There's no shortage of mortgage or loan officers. I hesitate there because I'm so used to using the word mortgage broker. Mortgage broker were very popular in 2003, 4, and 5, and they were a huge problem that led up to the financial crisis. They weren't, grounded to any particular lending institution. Their risk was, null and void in the sense that once you got the money, they were out of the equation, and then they didn't have to worry about whether you defaulted or not. That is much less common in today's market. There are still mortgage brokers, but the ease of getting a mortgage broker license combined with the ease of getting money, period, led to an influx of criminal minds into the mortgage broker industry that were preying on individuals and getting the right applications on loans that they otherwise would not qualify for. So mortgage fraud was taking off, and just tons and tons of mortgage brokers were just driving this fraud. Today, compared to 2005, I think it's been a 95% decrease in the licenses of mortgage brokers in the state of Florida. I can't speak for other states, but Florida, the mortgage broker license is completely different. It's regulated today in a much different way, and the marketplace is a much safer place for that. And again, a mortgage broker is somebody who just connects a lender, somebody offering money from a deficit spending unit. I always use the terms surplus spending unit and deficit spending unit to connect them. They really don't care about either party, they're supposed to, but in essence, they were not caring because they just wanted their commissions. But today, your loan officers are mostly grounded to a lending institution. Their commissions and their employability and their careers are tied to the performance of the loans that they bring in. Plus, there's stricter underwriting guidelines and regulations in place to protect against defaults. So got to take a break. Coming back from the break, though, I'm going to talk about some of the questions you should be asking your loan officer and what you should be aware of when you're making an application with a mortgage. So you're currently listening to the Real Estate Edition of That Business Show 2.0 with your host, Jamie Maloney, where business becomes show business.
Hi, welcome to Yeager's. We just want to take a minute and show you what we're all about. At Yeager's, our primary business is hardwood flooring, although we are remodelers for kitchen, bath, and general construction. We operate a fleet of shop-at-home vans that have all the flooring type products, hardwood flooring, laminate flooring, tiles, stone, what have you. So we're able to come out first with products in our vehicles and take a look at the setting, how the colors will work, and then to be able to come up with some options and ideas for you. If that's not good enough, we have a large distribution center that we inventory product and have a nice display area.
Hi, Jackie Skelton from JR World Travel here. If you travel, you need a licensed professional travel consultant, not a computer. Your licensed professional consultant can get you more for your time and your money. Value for your money and experience, not marketing salesmanship. When you're sick, you call the doctor. When you need legal advice, you call an attorney. So the next time you want to go on any type of travel, call your licensed professional travel consultant who actually represents you. We specialise in group travel, family reunions, weddings, to escorting large groups or making special arrangements for the disabled. Please call 844-249-0190. We are a full-service travel consultancy offering worldwide concierge service. Air, land, sea, rivers, resorts, locally, nationally and internationally. Remember that number, 844-249-0190.
Welcome back to the real estate edition of That Business Show 2.0, where real estate becomes show business. Today's topic is mortgages in general, getting the importance of getting approved, fully approved for a mortgage, questions you should be asking or looking at when you make application for a mortgage. And also on the second part of the show today, we'll be speaking with Frank Coto, who is a president of Lincoln Lending Group. That's his own company, and he can definitely help you with all areas of mortgages, from FHA and conventional to new products designed for distressed borrowers. They now have 1 day out of bankruptcy, 1 day out of foreclosure, and credit scores as low as 500 can even apply for a mortgage through Lincoln Lending Group. And LincolnLend.com is their website. In the meantime, 813 Mortgage is their phone number. You drop the E, he drops the fee, and we'll explain that also when he is on the program on the second part of today's show. So when people go to make a mortgage on a property, what's the first thing they're probably going to be concerned with? That's the interest rate. Interest rates right now are at historic lows, and they are predicted to rise over the next couple of years. So buyers that are sitting on the sidelines hoping that values come down may lose that additional spending power with the increase in the interest rate. So, it's a balancing act there. You pay less for a property, but the interest rate is higher. You didn't really win. You just canceled the two out. And so interest rates right now hovering anywhere between 4 and 5% on average. Historically, the average is 7 to 8%. So you can see that even in today's marketplace, 4 and 5% look great. The last couple of years, they've gotten down to the 2s and 3s, and it just, how does a lending institution even make money at that level? But I don't want to get into that talking point right now. In the 80s, interest rates 15%, for even the best of borrowers. And how could you afford a home at that price? The fortunate thing about this last financial crisis is that interest rates, remained low, and the Fed needed to keep them low to keep the economy from going into a complete meltdown, which reciprocated into the mortgage markets, of course, to keep the rates low on the loans. But can you imagine what a 15% interest rate would do in the housing market today? Values would have to come down. Buyers can't pay more money. They only have a certain amount of income that they can dedicate to the monthly payment. So a higher interest rate just punishes the sellers by driving the property values down. So the interest rate is where you're going to be looking for first. You'll want to understand the difference between your interest rate and your annual percentage rate, your APR. There's a disclosure that explains that. You'll see a certain rate advertised, and then you'll see an APR, which is adjusted for an annual basis. I hate trying to explain it. It always tricks me up, but there is a disclosure that explains the difference between your interest rate and your APR. The next thing that people are concerned about is just what the monthly mortgage payment is. And this is really what got borrowers into so much problem in 2004 and 2005, because that was all they were concerned about. They weren't asking questions like, is the mortgage fixed or is it an adjustable rate mortgage? Because they didn't want to. They didn't think to ask it, or they weren't being provided with proper disclosures and discussions with people to make them understand what that means. They just said, your mortgage payment is $1,200 a month. Okay, we can afford that. They didn't know that in 1 year there's an adjustable rate mortgage that kicks in. So the interest rate will go from 3.5% to 7%, or whatever the case may be, and your monthly payment is going to adjust. So you got to understand the difference between fixed rate mortgages, adjustable rate mortgages, mortgages with a balloon payment. A balloon payment is where you make regular monthly payments up until a certain point, and then the entire amount of the balance comes due. Those are very common with adjustable rate mortgages. You have a certain percentage up until a year or 5 years, and those are designed really to be refinanced, but people are not explained the way that they're supposed to utilize these products. They just say, what is the monthly payment? And then I'm going to go buy a home based on that. So it's best to get a fixed rate mortgage versus an adjustable rate mortgage, unless you know how to use the adjustable rate mortgage and you're waiting to maybe your credit improves and you can get a fixed rate product maybe in 12 months or in a couple of years, and then you can refinance. Fixed rate mortgages are the backbone of the mortgage market. A 15-year mortgage and a 30-year mortgage are the two standards. A great tip that I can give to borrowers too is if you take out a 30-year mortgage and you make one extra payment per year, that payment goes directly to the principal at that point, and you can turn a 30-year mortgage into like a 17 or 18-year mortgage simply by making that one adjustment. And whenever you get a mortgage, your mail usually fills up with offers on how to speed up payments and how to reduce the time of your mortgage, and that's what those offers are centered around, making that extra payment or somehow applying extra principal throughout the year. So a 30-year mortgage then turns into more like a 15-year mortgage. So be sure that you're getting a fixed rate, or that you know how you're using an adjustable rate mortgage to properly refinance yourself and not put you in a position to where you're going to have to sell or unfortunately may get foreclosed. What fees do you have to pay? Common question with any real estate transaction I'll get is, I hear a lot about closing costs when I buy a home. What are closing costs? Closing costs are costs that you must pay to close on the transaction. The majority of them come typically from the mortgage. If you're buying a home with cash, there's only a couple of fees you even need to be concerned with. And those are typically paid on the seller side. That is your doc stamps on the deed, which is a state tax, 70 cents per 100. So you take the purchase price divided by 100 times 0.7. That is a set rate by the state, again, set based on the price of the property. That is generally paid by the seller, so you as a buyer do not usually have to worry about that. The other fee is the title insurance, and most of the time the seller pays that. Other markets may have different practices. Again, a lot of markets in real estate practices are specific to the area, but I'm speaking strictly from the Tampa Bay real estate market at this time. And so a person purchasing with cash really shouldn't have closing costs in excess of $500. Investors who are very savvy in this business will demand it to get even lower. So where are the costs coming from? They're just closing fees, notary fees, wire fees, things like that the title company, the people that close the transaction and who process or broker the title insurance, charge to both the buyer and the sellers. But buyers that are savvy and paying with cash, anything more than $500, you need to be pushing back on the title company and getting those fees reduced. And a lot of times, 9 times out of 10, you'll get a title company to reduce their fees when they're charging, you more than $500, $600, $700. Then if you're paying over $1,000 in closing fees, and this is in Tampa, I can't speak for other markets, then you're paying too much. So keep in mind the fees that you have to pay. The majority of your closing costs are associated though with the mortgage. Now, when you buy a mortgage, one thing you may be asked is paying points. What is a point? A point is paying interest prematurely, or prepaid interest, and it's 1% of the principal of the mortgage balance. So why would somebody pay a point? Well, they pay a point to push down the interest rate. Now you need to calculate though how long you're going to keep the property to know if this is even worthwhile. Should you pay a point to reduce your interest rate from 4 to 3.8? Well, you're going to be saving a certain percentage of interest, but if you're going to be selling the property in 6 months, you may be losing money because that interest hasn't accrued at that point onto the property. So there are simple calculators that are out there. I used to have one on my computer, but I don't at this time. But it would calculate for you how long you needed to own the property to make paying a point on a mortgage be worth it. And again, paying points is nothing more than prepaid interest that you are paying, and the point is equal to 1% of the mortgage. Whether or not a loan has prepayment penalties, something to pay attention to. Most of the conventional products, FHA products, do not. When you start getting into private money and hard money, those loans will have different types of terms that are non-traditional, but you definitely want to know for sure and ask the question, does my mortgage have a prepayment penalty? Assumability of a mortgage is another good question to know about. It means that you can sell the property and then the new borrower can assume your mortgage. Now, why would somebody want to assume your mortgage? What advantage would this have? Well, if you are currently buying a property in a low interest rate environment and you have 30-year mortgage locked up at 4%, in 5 years from now, when you go to sell the property, interest rates have adjusted to 9%. you now have a selling point that you can offer to the borrowers to say that, listen, I've got 25 years left on this mortgage at 4% or 5 or whatever I said, 5%, and then they can go get a mortgage for the difference at the market rate of 9%. So the assumability of a mortgage is an excellent selling point for situations where interest rates have climbed. In my 10 years in the marketplace, we've not seen that become a player in driving real estate transactions, but in real estate markets of the past, whether or not a mortgage is assumable is definitely a selling point for a mortgage, and something you should be aware of. And all this stuff is disclosed on the disclosures that a loan officer will be giving you at the time of your application. And we'll be talking about that on the second part of today's program. Again, we'll be hearing from Frank Coto with the Lincoln Lending Group. The down payment required is another concern with purchasing a mortgage. FHA mortgages are 3% down. Frank will be talking about a new conventional loans that are out there with just 1% down. The lower the interest, or the lower amount down, just usually means higher down payment. He'll be explaining that on the second part of today's program. But the down payment that you will pay, traditionally 20% was required, back in 70s and 80s. Today, though, the mortgage market much more liquid and much more players than there were back then. So a lot of different products out there with different down payment requirements. Mortgage insurance, something that we'll be talking about on the second half of today's assurance. Make sure that you understand what mortgage insurance is. And what that is that is an insurance that protects the lender against default, and it kicks into play when you don't have enough money down on the mortgage. So by putting more money down, you're going to avoid the cost of mortgage insurance. So those are just some of the questions that you should be looking for when you go out there and apply for a mortgage. So when we come back from the break, we're going to be hearing from Frank Coto, president of the Lincoln Lending Group. He's going to talk specifically about some of the loan products that are on the marketplace and how he can help you save money over at Lincoln Lending Group. And learn more about this program at thatbusinessnetwork.com, and catch new editions of the real estate program each Thursday morning at 7 a.m. on that program or on that website, thatbusinessnetwork.com. You're listening to That Business Show 2.0 with your host, Jamie Maloney, where business becomes show business.
Hi, welcome to Yeagers. We just want to take a minute and show you what we're all about. At Yeagers, our primary business is hardwood flooring, although we are remodelers for kitchen, bath, and general construction. We operate a fleet of shop-at-home vans that have all the flooring type products: hardwood flooring, laminate flooring, tiles, stone, what have you. So we're able to come out first with products in our vehicles and take a look at the setting, how the colors will work, and then to be able to come up with some options and ideas for you. If that's not good enough, we have a large distribution center that we inventory product and have a nice display area.
Hi, Jackie Skelton from JR World Travel here. If you travel, you need a licensed professional travel consultant, not a computer. Your licensed professional consultant can get you more for your time and your money. Value for your money and experience, not marketing salesmanship. When you're sick, you call the doctor. When you need legal advice, you call an attorney. So the next time you want to go on any type of travel, call your licensed professional travel consultant who actually represents you. We specialise in group travel, family reunions, weddings, to escorting large groups or making special arrangements for the disabled. Please call 844-249-0190. We are a full-service travel consultancy offering worldwide concierge service. Air, land, sea, rivers, resorts, locally, nationally and internationally. Remember that number, 844-249-0190.
And welcome back to the real estate edition of That Business Show 2.0, where business becomes show business. We're going to be talking with Frank Coto now for the rest of the program. He is the president of Lincoln Lending Group, and you can learn more about him at lincolnlend.com and give him a call for your mortgage wherever you are in the country. 813-MORTGAGE. You drop the E and he drops the fee. So Frank, welcome to the program today.
Hey, thanks for having me on, Jamie.
And so, Frank, what's going on in the mortgage markets today? You know, we hear a lot about, interest rates are low, but they're starting to come up. First off, what's going on in the markets out there?
Well, what's going on in the markets are definitely interest rates are going up. There's no question about that. We have gone a little bit back and forth with some of this uncertainty in the market. But overall, what I'm seeing are home values rise, interest rates slowly on the rise, but the best part about it is there's a lot of mortgage products available now that were not available just last year.
Yes, and we used to do a regular program on 1250 WH&Z, and we did a regular real estate edition of the program each and every week. And I remember we were talking about this last year, and subprime was starting to move back into the marketplace, and these loan products were starting to come back into the availability for people buying their homes. What's out there now that wasn't out there like a year ago, for instance?
Okay, there's a couple things. We'll start with the people that are A-paper borrowers, the good credit guys. The most exciting product that has just come back out, actually not come back out, was just released in late January, is a 1% down conventional mortgage. So instead of having to put 3% or 5%, if you have over a 700 credit, and with a couple other minor restrictions, you can put as little as 1% down with reduced mortgage insurance. That's the most exciting product for an A-paper borrower. There's a lot of subprime lending that is starting to come back into the market. Now, a lot of people, they hear the word subprime and they get a little bit scared because that's what is synonymous with the downturn in our market around about 10, 11 years ago. Subprime loans, back in the day, we were giving 100% financing to your hamster, basically, with no income documentation. But these loans that we've come back out with now, they allow people to buy or refinance just one day after bankruptcy, foreclosure, or short sale. However, as scary as it sounds, they require to have a pretty large down payment. So you're going to have minimum probably 10% down all the way up to 30% down, depending on how bad your situation is if you want to get into one of these subprime loans. But it's opening the doors for buyers who otherwise wouldn't qualify.
Well, that's the way it used to be in real estate anyways. You were expected to have 20% down, in the old days. My dad reminds me of that all the time. What's different about today's mortgage market versus 2004 and 2005, which led up to the financial crisis and the near meltdown of the economy? I mean, are there new restrictions or new regulations in place that at least protect us from that environment again?
There are definitely some restrictions in place. The biggest thing that you can do to prevent that type of downturn and the negativity in the market is just the down payment alone, skin in the game. Personally, I'm not a big fan of the down payment assistance programs, although they're becoming more and more popular. And this is just my opinion, but to me, when you don't have skin in the game, it's a lot easier for you to walk away from a house or from a mortgage. And that's really what was happening back in the day, is people didn't have any skin in the game. So what do they have to lose to walk away from a house? Where today, the market, I think we're approaching the point where we're almost as strong as we were in the mid-2000s before the downturn, with the prices of homes going up and the availability of lending products. But we're requiring people to put down. That brings a very good point. There's another incredible product that's out. It's an FHA low credit score loan that is, I would say, almost exclusive to my company. I haven't met anyone in town that offers anything, or actually, let's say in the state of Florida, that offers anything like this. We go down to 500 credit score on FHA loans.
Wow.
Where most lenders are going to tell you 620 or 600 on an FHA loan. We can go as low as the 500, but here's the key. This is how we're making it safe. Is if you have under a 580, we're going to require you to put down 10% instead of the normal 3.5%. So you follow where I'm going on the whole skin in the game.
Right.
Some equity.
But still, I mean, a 500 credit score before, I mean, is there any other loan programs that would look at somebody with a 500 credit score? Is that the only one out there?
Subprime lending would look at it, the one where I can do one day out of bankruptcy, foreclosure, short sale, bank statement lending. We have some stated products that we can get into and talk about for investors. But the best product for you to buy a house for you and your family to live in and still get a good interest rate is going to be the FHA low credit score. For instance, an FHA loan today, we would probably at Lincoln Lending offer 3.75% interest, maybe an APR around 3.85 on a decent credit, maybe 620 with 3.5% down. If you are the low credit score program, that same house you have to put 10% down on, but your rate is still going to be in the fours. You're probably going to be at 4.5%. So that's the big difference between government lending and subprime lending. This program's special because you can get a really good interest rate. You can get a loan that you can live with for the next 30 years with your family. Compared to subprime, you're going to have at least 10% down, probably more. And your interest rate is, I'm going to say, be in the 7s or 8s if you have that kind of credit score.
Now, you mentioned the 1% conventional down. I've been hearing about 3% conventional loans. I remember in 2004 and 2005 and 6, when I first got into real estate, brokers were telling us that FHA loans, nobody did them anymore because now you can get 0 down, 1% down, 3% down. Is there any, fear that the FHA loan is kind of getting pushed to the side for these, alternative conventional loan programs?
That is a great question. I don't know if you remember, Jamie, back in January, right before Obama left office, he signed some sort of executive order which was changing some of the rules for FHA loans. And originally we thought he was changing those rules because he was trying to help people buy more homes and make the FHA loan more affordable. I don't ever think, to answer your question, I don't ever think FHA is going away. FHA, the difference in FHA, before I get back to the Obama story, the difference in FHA and conventional are a couple things. A, credit score. Conventional has a hard stop at 620. I've never known any conventional program to go under a 620 credit score, at least not in recent years, where FHA doesn't actually have a minimum credit score. When I do these seminars with 100 agents in the room, I always ask a funny question and I say, hey, what's the minimum credit score for FHA? I'll give you a prize if you get the answer right. And all the hands in the room go up and some person says, oh, it's a 600. The other says a 580, a 640. You get all these numbers. And the true answer is there is no minimum credit score. So the banks themselves have to set the credit scores for FHA, which allows us to be more lenient and get more people into homes. The other thing the FHA does different than conventional is they allow you to go up to a higher debt ratio. We could go as high as maybe 57 or 58% back-end debt ratio on FHA, where with conventional, you're not ever going to get better than 49% back-end, and that's with a really good credit score. So FHA is always going to have its place. The other thing is FHA is backed by HUD, Housing and Urban Development. So it's really more of a government loan than a conventional loan, even though conventional does have some government ties with Fannie Mae, Freddie Mac, and whatnot. FHA is your true government insured loan. So going away, I don't think so. But going back to my mention of Obama and that executive order, the main problem with FHA and the reason FHA is not liked by banks, and people don't know this, but banks and the back end players, the big boys in the mortgage industry, don't like FHA because when somebody gets an FHA loan as, say, a first-time home buyer, and then their house value goes up, which you and I can both agree values are going up now, right?
Right.
Okay. So you buy a house for $100,000, you put down 3.5%. In a few years, that house will probably have 20% equity based on the current rate of appreciation. So what's the first thing somebody's going to do?
Refinance.
They're going to want to, bingo. They're going to want to refinance to get rid of that mortgage insurance. So what it does is it shortens the shelf life of the FHA mortgage, which means that those mortgages are only held for a couple years and then they're paid off. And the truth is, a lender doesn't really make money on a mortgage unless it's held for probably close to 3 or 4 years because they have to pay all those upfront servicing and underwriting costs back, and then they're collecting their money after that. So it's a bad gamble for these banks to keep doing FHA mortgage. So what Obama did was he tried to make the FHA mortgage more comparable to conventional so that people wouldn't want to refinance. And one idea was to allow people to drop the mortgage insurance. However, his idea fell short because he wanted you to keep the mortgage insurance for 11 years. So, I mean, who's going to keep it for 11 years when you can go conventional and keep it for 2 years and get out of it?
Right. Well, good information. Talk with Frank Coto, president of the Lincoln Lending Group. You can learn more at lincolnlend.com or give him a call anywhere in the country. 813-MORTGAGE. You drop the E, he drops the fee. We've got to take a short break, but when we come back from the break, I'll let him explain the you drop the E and he drops the fee portion of his business. And also, we'll chat a lot more about what's going on in the mortgage markets and touch on the VA product for all the veterans out there in the marketplace. A great way to purchase a home with no money down. So again, Frank Coto, president of Lincoln Lending Group at lincolnlend.com. You're listening to the Real Estate Edition of That Business Show 2.0. I am your host, Jamie Maloney, where business becomes show business.
Hi, welcome to Yeager's. We just want to take a minute and show you what we're all about. At Yeager's, our primary business is hardwood flooring, although we are remodelers for kitchen, bath, and general construction. We operate a fleet of shop-at-home vans that have all the flooring type products, hardwood flooring, laminate flooring, tiles, stone, what have you. So we're able to come out first with products in our vehicles and take a look at the setting, how the colors will work, and then to be able to come up with some options and ideas for you. If that's not good enough, we have a large distribution center that we inventory product and have a nice display area.
Hi, Jackie Skelton from JR World Travel here. If you travel, you need a licensed professional travel consultant, not a computer. Your licensed professional consultant can get you more for your time and your money. Value for your money and experience, not marketing salesmanship. When you're sick, you call the doctor. When you need legal advice, you call an attorney. So the next time you want to go on any type of travel, call your licensed professional travel consultant who actually represents you. We specialise in group travel, family reunions, weddings, to escorting large groups or making special arrangements for the disabled. Please call 844-249-0190. We are a full-service travel consultancy offering worldwide concierge service. Air, land, sea, rivers, resorts, locally, nationally and internationally. Remember that number, 844-249-0190.
And welcome back to the Real Estate Edition of That Business Show 2.0. I'm your host, Jamie Maloney, where real estate becomes show business each Thursdays morning, 7 a.m. on thatbusinessnetwork.com. So on today's program, we've been talking all about mortgages, questions you should ask your loan officer, what you need to be aware of when you're applying for a mortgage, the importance of getting a full loan approval. And in that last segment, talking with Frank Coto about, FHA mortgages and products available on the marketplace. And Frank is still with us today. We talked in that last segment about, your phone number, 813-MORTGAGE. You drop the E, he drops the fee. So talk to us about the fees associated around mortgages and how you are different from the others.
Thanks, Jamie. Yeah, the big thing that sets me apart, and I started this a few years ago to set myself apart from all the banks when they were increasing their fees, was I came up with the 813 mortgage, you drop the E, we drop the fee. What that means is we're not going to charge your clients any fees for loans. What that means is no processing, no underwriting, no broker fee, no administration fee, no bank fee. Trying to think of what else. Basically, no junk fees, no points or anything like that are going to be charged to your client on conventional or government loans. Those charges are, for the most part, junk fees that the banks don't have to charge. But we've become so accustomed to paying those on all of our closings that we think it's just a normal fee, but it's not a normal fee. I run a very successful mortgage company without charging your clients anything. The whole thing about the E was kind of funny because mortgage is one letter too long, so you can't dial the E anyway on a cell phone these days, or it'll ring disconnected. So I came up with the funny slogan, dropping the E and dropping the fee, because I was already dropping the fees.
Right. Well, it's definitely a catchy slogan and easy to remember. 813 Mortgage, you drop the E and he drops the fee. Now, I want to talk a little bit about the VA mortgage available to veterans out there, no money down. How come a lot of people aren't even aware of this who served our country?
Yeah, it's really sad. I feel like the VA just doesn't tell them that this is available. A lot of them come out of the service and they don't know not only what a great loan it is, but it's available to them. The VA loan is the best loan money can buy, hands down. It's no mortgage insurance, 100% financing, incredible interest rates. I mean, we're talking 3.75%, 3.875% APR on a 30-year fixed with no prepayment penalty whatsoever, no down payment. I mean, it's amazing. It's also one of the only assignable mortgages left in the market, which means if you find a veteran to buy your house, they can get that interest rate, let's say that you got 10 years ago. So in the coming years, the VA loan's value is going to go up tremendously as the interest rates increase.
You know, I talked about that in the opening segments here, the assumability features of mortgages, and they've not been, in play over the last 10 years or so because it's, interest rates have been low. But if we ever get into an environment where interest rates are skyrocketing again and you're locked in at 30 years at 4 and 5%, that becomes very attractive. Is that something down the line, though, that as interest rates go up, that lenders will begin to offer assumable mortgages again, or are they gone for good?
I think conventionally the assumable mortgage is gone for good, not because of anything negative, just because it's a lot of work. You have to have a specific department to deal with assumable mortgages. And the thing is, you still have to qualify for the loan. So, and the lenders, I mean, conventional mortgages are backed by private enterprise. So, if you're lending your money, you're going to want to make more than 4%, right? So I don't think you're going to see that on the private side. But on the government side, I think it's going to be around for a while. I mean, it is a major benefit to veterans, and it's only going to get better.
Very cool. Well, we got to wrap it up. I know Frank had to run here. That's why we see him in the car. And now, if you're watching this on video, he's running to appointment to appointment. A lot of business out there. So take advantage of getting a mortgage. 813 Mortgage. You drop the E, and he drops the fee. So Frank, we'll check back in with you again soon. Thank you so much for being with us.
Thanks, Jamie. Have a great show.
Absolutely. And learn more also at lincolnlend.com. And he was talking about, the interest rates and, how they are available to, I would say, to the banks, or the assumability feature. And what I wanted to get at there is how that, a mortgage is not, a great investment for a bank. I mean, you tie up money for long periods of times at a fixed rate. And then if interest rates rise, and the banks have that money tied up at a low interest rates. And then if rates, are high and they lend at a high interest rate environment and then the rates fall, borrowers refinance. And so it's just not a good deal for people. Another reason, though, to get a loan officer involved so you can learn these types of things about how the real estate and the mortgage markets work. Frank Coto, president of the Lincoln Lending Group. A lot of great information on a lot of shows with them. He was an integral part of the Jamie Maloney, the real estate show, the real estate edition that we were doing on 970 WFLA. That has now become the Business Happy Hour. He has his own show on 970 WFLA, airs each Friday on webeamtv.com and also on 970 WFLA locally, where they just talk about business and have some fun, and then sometimes drink some beers on the program. So again, they're just talking about mortgages, and in the last few minutes here, I just want to kind of sum up, the mortgage markets there and how it functions and the liquidity factors behind what drives the markets. As I was getting at a moment ago about how mortgages are not a good investment for a bank. If it weren't for Fannie Mae and Freddie Mac providing a secondary market, you would see home ownership much lower in the country. You would see home ownership requiring a much higher down payment and much higher interest rates. associated with them. But because Fannie Mae and Freddie Mac exist, they provide a secondary market. They securitize the mortgages into principal, interest, different types of components, and then they basically increase the warehouse line back up to funding levels for the lenders to be able to make their loans to borrowers. If it weren't for Fannie Mae and Freddie Mac, which came out of after the Great Depression, part of the New Deal and everything, that was provided much liquidity needed for the real estate markets. Another big component of the real estate mortgage markets is the presence of FHA and the VA. Those are insurance programs. They are not lending programs. They are insurance programs to protect lenders against default. And so if you're a veteran, you can get a VA loan, no money down. A great tip that I've seen some veterans utilize is you can buy up to a 4-unit property with a VA loan. So a duplex, triplex, 4 units. As long as you're living in one of the units, you can rent out the other units and then turn your mortgage into your mortgage property into a positive cash flow situation. The number one tip that I get from real estate investors is if you have a VA benefit, take advantage of that. Buy a multi-unit property. You can buy up to 4 units, live in the 1 unit, and then rent out the others. And if you've got 3 units paying you, then you're going to have definitely a positive cash flow no matter where you are at in the country. FHA, the insurability, offers lenders the assurance that their properties, that their money will not be lost in the event of a borrower default. Without the FHA insurability, many lenders would not make loans to higher risk borrowers because they do not have enough money to secure the collateral. Only 3% down does not provide enough of a cushion to the lender in the event that the prices of the real estate fall. That's why historically they wanted 20% down. That gave them a 20% cushion. If at the time they made the loan application and the property fell in value, they were still adequately protected. So again, just another reason to contact a real estate professional to help you find a home and a loan officer to help you navigate the mortgage markets. A lot of stuff to know and a lot of good information you can pick up along the way. Always happy to talk mortgages with people as well. Not my specialty. That's Frank's department. My specialty is helping you finding a home or helping you sell a home. And you can do that in a couple of different ways with me. Go to thathomevaluation.com and we'll help you get a price on a home. And it doesn't matter where you're at in the country. We have a vast relocation and referral network of professionals, and we can partner you up with a Coto banker agent anywhere in the country. Again, go to thathomevaluation.com. And also we've built out thatbusinessnetwork.com to have real estate functionality now. And so that's the old Tampa Bay radio site had that. It took me a little bit of time to get that back into the new site. But if you go over to thatbusinessnetwork.com, there is a real estate tab there where you can search properties once again, and a mortgage calculator, ability to search rentals, commercial properties, vacant lots, and land, all that stuff over there on thatbusinessnetwork.com on the real estate tab. And again, new episodes air each weekday mornings at 7 a.m. on thatbusinessnetwork.com, the real estate edition, in addition to our weekly features each Monday through Friday, where we talk with different professionals, and we'd love to hear your story too. Go to tbsinterview.com for more information on how to appear on the program, tbsinterview.com, and connect with us on social media. We're on Facebook at facebook.com/thatbusinessshow. Also, you'll find us on Twitter at thatbizshow, and our YouTube channel, easy to find. Simply go to thatyoutubechannel.com. So you've been listening to the real estate edition of the program. We'll see you back in here next Thursdays on That Business Show 2.0, where business becomes show business.